Good morning, welcome to the Australian Early Finance Briefing for Wednesday the 29th of July 2020. My name's Nick Hurley, I'm here in Melbourne. Starting today with a statement from the Sydney office of PIMCo. They did an interview with the AFR this week, mentioning that they see there's a significant risk of corporate defaults as policymakers cut back on widespread support and shift towards more targeted pandemic spending. That is certainly what we're seeing here in Australia with the revised JobKeeper 2.0 announced last week, which significantly cut the wage subsidy program. They say trillions in government and central bank spending have shielded the majority of companies from the worst of the epidemic, but this may not continue. The next phase of policy will be much more targeted globally. For companies that are too highly leveraged or struggling to conduct business in a post-pandemic world, we think a lot more of these will be allowed to fail. Now, that's consistent with a number of other investment banks. They're all sort of expecting that corporate defaults will pick up. We really haven't seen that much so far. There's been the high-profile ones such as Hertz and Virgin Australia Airlines. But considering the enormous sort of depression scale economic decline we've experienced, there's been really a small sprinkling of defaults. Interestingly, in PIMCo's interview, they did mention that one of their strategies they're playing is a roll strategy. So the RBA currently has a sort of a verbal yield curve control guarantee that they'll keep the 3-year yield up to, I think, 0.25%. And what PIMCo are doing is they buy securities that roll down to that 3-year point. Continuing with the topic of corporate debt, The Economist this week looks at the corporate debt problem in the US, which is something we've touched on recently. Corporate debt's, although it's reached an all-time high, the bulk of the debt funding has come from shadow banks rather than the large sort of US regulated banks. So the bank debt provided to the corporate sector has increased by 2 percentage points of GDP since 2012, but the amount driven from the non-bank sector has been 6%. So even though the banks are sort of very flush with capital and much more secure, as a result of the regulations that came in after the global financial crisis, they're not really financing a lot of this corporate debt. Now, the FSB, which is a Swiss-based body that looks at financial stability worldwide, did an analysis, and they found that there was $51 trillion of debt in narrow shadow investments. Almost 3/4 of that is held in instruments with features that make them susceptible to bank runs. And this slice has grown rapidly from 28 trillion in 2010, and in the US alone, it's increased to 15.3 trillion. And the assets of the commercial banks was only a little bit bigger at 15.6 trillion. So obviously here in Australia, we don't have anywhere near as much of this sort of shadow banking system. Very concentrated, dominant Big Four banks that do most of the lending throughout the economy. Now, in the US, we're seeing a growing number of capital market functions and a great deal of credit provision done to firms sitting outside the banking system. Now, that has posed a problem with the sort of stimulus measures in the corona pandemic, because the tools that the Federal Reserve would like to use to increase lending doesn't really impact these entities that sit outside their sort of universe. But when you actually look at it from a sort of a too big to fail perspective, so part of the problem back in 2008, where we had these huge banks like Bank of America and JP Morgan, that literally if they collapsed, there would be dramatic ramifications. having this sort of broad shadow sector where there's no too bigs in that area, that even if one was to fall over, you don't have this sort of too big to fail problem. Now, we don't really have that here in Australia, and maybe that's time to look at that, because having these too big to fail banks in Australia, the CBA, ANZ, NAB and Westpac, they have to follow very stringent lending guidelines because they're so heavily regulated. Maybe it would be better for our economy if we had some of these slightly more riskier shadow banks. There are some, but certainly not to the scale in the US, where they will be much more willing to provide credit to the businesses that really need it to grow, which certainly wouldn't hurt coming out of this terrible recession. Now, gold hasn't really moved much since yesterday. It got very close to another big high, but it's sort of a little bit off this morning. Rio Tinto, which makes most of its money from the Pilbara iron ore, has announced that it's ready to take a leap into gold mining, getting on the bandwagon. It says it has tenements in Western Australia's Paterson province, which could support multiple gold and copper mines. The two minerals are normally found together. They'll accelerate the development of the Winu copper gold mine after long-awaited details of the size were announced yesterday. This area is very close to Port Hedland, well, a 7-hour drive from Port Hedland, so close by Western Australian standards. And moving to the markets now, the US has opened off a little bit. As you can see, it's down about 30 basis points half an hour after open. The gold price is off a little bit. It's at 1,931 US dollars an ounce, and the Australian dollar is staying pretty level at 71.46 US cents. Coming up today, we have the Australian CPI reading. Unsurprisingly, it's going to be quite negative. The quarter on quarter is forecasted to be an annualized negative 2%. So, obviously the low price of fuel and the economic decline is probably driving most of that. The year-on-year annualized level is expected to be 1.4%. So inflation is certainly not something at the forefront of most people's minds. And that's your early update for Wednesday. See you tomorrow.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.